I'm here with Sheila Bair, former head of the FDIC and Yahoo Finance contributor. Sheila, nice to see you.
Happy to be here. Thanks for having me.
I'd like to ask you, first of all, how you would assess the programs coming out of Washington, both fiscal policy and monetary policy.
Well, I would give them high marks. It's been far from perfect. The problem is the way we are set up. So we're set up to stimulate the economy primarily by defaulting to the Federal Reserve, which is equipped to lend to big banks. That's kind of what they do. So to their credit, both Congress and the Fed have tried to get creative to have a transmission mechanism that more directly reaches into Main Street. But not surprisingly, there are some issues there. And I think one of the many lessons learned going forward is we really need to rethink our payment system, how we get money from point A to point B, who we help, and how efficiently we do that. Because right now we are still using big banks primarily to intermediate all this, and it's just very imperfect.
Did we learn anything from 2008, 2009? You were critical of that process.
Well, I was. I think, yes. I think they are trying to get more, they're more mindful of getting the money directly to Main Street, not just infusing liquidity into large banks. There's been plenty of that, too. But I do think that has been a lesson learned, particularly the Fed. The Fed's being more transparent. They just released, publicly announced yesterday, they're going to provide a lot of detail in terms of non-financial companies, at least, that are getting help. We won't have much transparency around the big banks, but for the non-banks, there will be a lot of transparency. And that's good because that was another area where they were criticized in 2008 and 2009. So, yeah, again, it's imperfect. We're learning a lot, and hopefully this will precipitate some changes once we get through this terrible crisis. But for now, I think they are doing better than kind of the big bank bailout mindset we had during the great financial crisis.
Is there a way to improve how money flows to small businesses?
Well, there absolutely is. I think we're still using loans primarily to help small businesses. There again, you have to use the banks to intermediate. Not surprisingly, the community banks are doing a better job than the big banks in this because the community banks do the lion's share of lending. But nonetheless, it is an intermediated process. Their loans, they have to be repaid unless you use them to support payroll. And so, again, it's good. It's helping a lot of businesses. There's been controversy, but I don't think we should lose sight of the fact that it has helped a lot of businesses. But going forward, I think we need to rethink this whole idea of using debt in the banking system to transmit stimulus, direct assistance to support payroll, doing what they do in Germany. If you keep these people on payroll, we'll subsidize part of their wages. That probably would have been a much more direct and efficient way of doing it than the way we are doing it with loans. But again, lessons learned. We're set up to use lending as a way to stimulate the economy, and that needs a fundamental rethink as well.
I know you're also concerned about mortgages and mortgage forbearance. What's the issue there, Sheila?
Well, this is very frustrating to me, Andy, because as you know, during the great financial crisis, I worked hard to save as many homes from foreclosure as possible through forbearance on mortgage payments or modifying loans. So Congress has asked and the government has stepped up, the GSEs have stepped up to provide forbearance on these mortgages. But here again, the servicers are not adequately equipped to deal with a large volume of requests for forbearance. So instead of using a one-size-fits-all, we're still seeing a lot of individual negotiations, one by one, processing a borrower request, a lot of misinformation. There was an article in the Wall Street Journal yesterday suggesting some servicers were telling borrowers that they had a balloon payment at the end of their forbearance period. I think what they meant to say was at the end of their 30-year mortgage, they could wait until then, when they sold the house or refinanced to pay off whatever payments went into forbearance, which is a good deal for borrowers. But again, the whole message was being garbled because we don't have a standard script. We don't have a standard format for processing these. Same problems we had in 2008. I'm hoping this will get fixed. I think the FHFA under Mark Calabria has been very good on this. And he's not just automatically defaulted to bailouts, which, a lot of other people here on fire, we got to throw money at everything. He's been pretty data driven about whether mortgage servicers need help. He's not supported a financing facility for them. He doesn't think the data is there to do that. I think that's right. And it is working. But again, they would do themselves their own favor if they would just standardize the script, have one message, and put a lot of this online, too, on online platforms as opposed to trying to do it over the phone. But again, absolutely the same problems we saw in 2008 and 2009. It's very frustrating.
The government is throwing trillions of dollars at this effort. And I'm wondering if we're borrowing from the future too much, or if there are going to be consequences, maybe particularly for younger people.
Yeah. I think there will be. And here again, we default to low interest, we default to the Fed, we default to low interest rates, we default to more lending by the financial sector to stimulate the economy. That is still the primary tool we are using. And government is taking on, of course, massive amounts of debt. And I think the latest estimates are around 3.6, 3.7 trillion for the deficit this year. My guess is it'll go higher. So yeah, the Fed is monetizing most of that. So we're not having to rely on foreign investors or private investors right now to step up and fund all of it. But that works until it doesn't. We probably will exceed the levels as a percentage of GDP of deficit spending and the national debt that the previous historic high was after World War II. We did unwind out of that after World War II. There was a period of inflation after that, which frankly didn't really get tamed until Paul Volcker came in. So I think we need to learn from that lesson. Yes, we need to open the spigot now. We're in a different kind of war, but we need to unwind these programs quickly as we can without disrupting the economy, and be mindful that there is, history shows there is inflation risk in this. It's been so long since we've had to worry about inflation. People are getting complacent about it, but it's still there. And so I think that's the Fed didn't move very quickly to get out of of low interest rates after the great financial crisis. And what they did was it encouraged a prolonged period of borrowing, especially by businesses. And by government. So we had a very leveraged economy going into this. It made us less resilient in terms of being able to absorb the shock. That's another lesson about keeping interest rates too low for too long.
And final question, Sheila, how much in the soup are we here? And how do you see things playing out over the next months and years?
Yeah, so I think we're in pretty hot soup. There may be some good things to come out of this. I did a program yesterday with 25,000 high school students with one of your competitors, CNBC and Junior Achievement. But, we had some great questions from young people. And I think to some extent, they are rethinking this whole consumption-driven, debt-driven kind of economy, short-term thinking economy that we have. So maybe COVID-19 has forced us all to retreat to our homes, but maybe we're doing without some things we thought we needed to have. So maybe we will rethink all of that culturally. And that may have transitory negative benefits on the economy, but we might, on the other end, come out with a more economically sustainable, value-driven economy. So maybe there are some lessons that we are learning. But I certainly, again, hope we can get off of this debt carousel that we've been defaulting to every time we get into economic trouble, defaulting to lower interest rates, more borrowing. That's robbing our kids' economic future. Using whether it's student debt, whether it's business debt, mortgage debt, which fortunately is less of a problem this time, but it is weighing on their economic future, and that's not fair to them. And that's something my generation we need to step up and try to get fixed.
Sheila Bair, former head of the FDIC and Yahoo Finance contributor. Thanks very much. Nice talking to you.
Nice seeing you, Andy.